Hello, I am Kyle Demian from the Wealth Academy, and today we're going to talk about the personal pension plan and really a way to maximize your retirement. And as you see here, how to protect and secure your retirement so that you can have more, you can live more, and you can worry less. Now, the first part I wanted to talk about is just what happened to pensions. And the short and simple answer is they discovered the 401ks. And the 401k was first created in November of 1978. And the two main reasons that employers started moving to 401ks over the pension was the costs and the risk. Traditional pension plans were expensive for employers to manage and maintain, and this required the companies to make regular contributions. And with that, they assumed all of the long term financial risk for their employees and their future retirees. And one of the problems they figured out was life expectancies were starting to increase and also uncertain financial markets. So the costs and risk of maintaining those plans, those pension plans in the past, only escalated. So they started to move to 401ks. And the main difference was that these 401ks transferred the investment risk from the employer now onto the employee. So employees became responsible for their savings or retirement and a good chunk of their retirement income. Now, with that, what has that done to individuals' retirement accounts? It's brought on three new major risks, those being investment risk, longevity risk, and also the lack of guaranteed income. So that's where a personal pension plan can come in. Whether you save money just inside of your bank account, or if it's inside of a current 401k or IRA, something similar, you can leverage and set up your own personal pension. And a personal pension is just a strategic approach to retirement that is going to leverage a tax sheltered annuity to safeguard and grow your assets. So, in an era where traditional pension plans are becoming rare, a personal pension plan offers you the control and security you need for not only a stable financial future, but a stable retirement. And now we're not talking about just any annuity. And these aren't your parents or your grandparents' annuities from 20, 30 years ago. They have changed a lot. And for this strategy, we would use a specific type of annuity, and that it would be a fixed indexed annuity. Okay. And I'm really big on definitions and just understanding things based on what the actual words mean. So if we're to break down fixed index annuity, let's take it word by word. Fixed just refers to the interest earnings inside of the account. They're stable and they're predetermined. So unlike variable accounts or variable annuities, where you're going to get the ups and downs of the market, fixed accounts protect your principal from market downturns, and they offer a more secure investment option for the retiree. The index portion refers to similar to a stock market index, like the S&P 500 or the Dow Jones. These indexes track the performance of a portion or a segment of the stock market. So in a fixed index annuity, your interest rate or your growth is tied to the performance of a specified index. And while your investment does not directly participate in the stock market, the annuity's return is calculated based on the performance of the chosen index. And I'll tell you, some of the annuities that we use will average typically between 6, 7, 8% rates of returns, some even doing more than that, depending on which annuity is right for you. And then lastly, the word annuity as defined just means an account that provides a series of payments made at equal intervals, like your retirement income, right? It's often used for retirement purposes. When you purchase an annuity, you make a lump sum payment or a series of payments to an insurance company. That's what provides the protection. And in return, the insurer agrees to make periodic payments to you, either starting immediately or at some future date in the future. So annuities can be structured to pay out for a fixed period of time, for the lifetime for you as the retiree, or until the death of the annuitant and or a named beneficiary. So just to recap, personal pension plan does not have any market risk. We use a specific annuity that protects us from the market. We get market-like returns, averaging probably anywhere from 6 to 8% historically. Obviously, we don't know what the market's going to do in the future, but historically, if we look back, it's averaged about 6 to 8%. And then lastly, the option to have a guaranteed lifelong income at some future point in time, just like what pensions used to do for us when they were available. Now, from here, we go over to our forecasting tools, which allow us to help you plan your retirement income to make sure you're on track to fulfilling all of your retirement goals and your dreams. And this is where we can do a lot of calculations to calculate for market risk, for taxes, for growth, and to calculate your retirement income. And this is how we can really go through the math together to determine whether or not a personal pension account will make sense for you or if we're better off pointing you in a different direction. And I have no problem having that call with you to determine if we can help or not. If you want to plan some time where we can chat for maybe 10 to 20 minutes to kind of see where you're at, see what path you're going down, and to see if we can help, feel free to send me a message or click the link below this to schedule some time on my calendar and we can chat further.